5 seconds to the open. You ready?
Who wants to get this thing started right about now?
Welcome to Follow the Money Weekly with your host, Jerry Robinson.
Welcome.
Not just some guru.
Oh, really?
Your host is an economist and a best-selling author.
What an interesting news item. I'd better write that down.
And just someone who likes to make money and help you to make money. Welcome to Follow the Money Weekly. And here he is, Jerry Robinson.
Friends, welcome to the only radio broadcast dedicated to bringing you more truth packed into 1 hour than the mainstream media gives you all week long. You have found it. You're listening to Follow the Money Weekly Radio on the web at www.ftmdaily.com. That's followthemoneydaily.com. Well, we have a very good show lined up for you today. We're going to be talking about a lot of different things. First of all, what's been happening in the stock market. So I'm going to give you some analysis on what I think about the stock markets rising across the world, along with some ideas about this hyperinflation that has been forecast and predicted for so long. Where is it? Where is the hyperinflation? So we're going to talk about that a little bit. We're also going to have, as always, Tom Cloud on to talk about precious metals. In fact, we have a kind of an extended interview with him today, so looking forward to that. We'll also have Jay Peroni and John Burrs on, as always, providing you with some guidance and tips for your finances. Now, I was reading something earlier today which caught my attention. It was about how people are borrowing from their 401ks, and I just wanted to fit this in real quickly before I move into my primary commentary, because when you take a look at a brand new study, you'll find that more than 1 out of 4 households are dipping into their 401ks and using the funds not for retirement, but for personal expenses, living expenses, trying to make ends meet. And so one of the things that we've often talked about is the importance of having emergency liquid savings. We call it here DSL. It stands for Diversified 6-Month Liquid Savings Money. And in essence, what it is you take 6 months of your gross income. So if you're making, $30,000 a year, your goal, number one, is to get $15,000 or half of that, 6 months worth, into a form of savings. Now, what many people have said is, well, I don't want to put all that money in cash, and you certainly don't want to put it in the market because it's savings. So what we have done is we have developed a diversified model that we personally use, Jennifer and I, where we put 1/3 into U.S. dollars, 1/3 into stable foreign currencies, and 1/3 into precious metals. Through, from 2007 to 2011, a 5-year period, that returned 54%. 54% is what that DSL savings returned. Now, that's quite a bit. And especially when you compare that to putting, that money into a 3-month T-bill, which would, you would have actually lost money after inflation. After inflation was factored in, our DSL savings earned 54% during that 5-year period. Now, that's not typical for your savings account, right? But that shows you the power of diversification out of the U.S. dollar. Now, the dollar has become very strong as of late, and we're going to talk about that here in just a minute. But this study that was released by some outfit called Hello Wallet basically showed that people are taking money out of their 401ks and using it for basic financial needs. And that's going to really hit hard when these people reach retirement. Them are not properly prepared. And we've gone over those numbers. We've talked about the absolute travesty that is the retirement savings in this country. 40% of Americans don't even have 5 Benjamin Franklins to rub together, right? 40%, 4 out of 10 people do not have $500 in liquid savings or in investments. Now, I want to talk a little bit about what we've been seeing in the markets, because it sure is turning heads, especially this week when we saw the headlines coming out. Tuesday, March 5th, last Tuesday, we saw some of the most economically positive news that I can recall in recent memory. Here are some of the headlines that I noted. Dow Jones rallies past 2007's all-time high. S&P 500 reaches 5.5-year high. The NASDAQ reaches a 12-year high. European stocks reach multi-year highs. Japanese stocks reach 4.5-year high. So there has been a lot of traction going on in some of the major stock markets around the world. The Nikkei in Japan, of course, many of the different Eurozone stock markets, and the United States have been huge beneficiaries over the last several weeks and several months. And there was even a report last week that showed that the market, as we see here, the Dow had finally reached an all-time high, passing the 2007 high. So in essence, after that real big dip we had in 2008 in the markets, we have now recovered fully from all of that, and now we're back into positive territories. We reached that flush point, and now we're moving higher. So, that causes a lot of questions for people who have been on the sidelines, which is most of Americans have simply been wrong about the stock market. They've had their money in bonds. They've had their money on the sidelines in cash. They've been afraid to enter into the markets, and that has been devastating to their future wealth because they have not followed the money. Of course, that's the name of this program, Follow the Money. Now, you got to realize that the big institutional money, the money that's held by hedge funds, the money that's held by these major institutional investors and funds and other things, you watch them, you pay attention to them. And for the last several weeks, we have had a full-blown green light to invest over on our Trigger Trade Report area. I'm also going to put that in the FTM Insider, by the way. For those of you who have no clue what I'm talking about, we actually use a red, yellow, green system. It's a real simple system that just simply shows you how we follow the money. If the light is green, that means that institutional investors are piling money into the markets. They're buying. Now, you don't want to bet against institutional investors because they can move markets in any direction that they want to move it by throwing money in. And they are skilled at manipulating the markets through that. So when they're piling money in and you are not, then you're missing out on gains. Or when you're shorting the market while they're piling money in, you're just losing money, basically. So right now, the markets are flashing a huge green signal. Now, some people say, well, it may be a green signal, but it's going to crash at any moment, so I'm not going to buy. Well, if you haven't bought up to this point, I think you could probably build a case that maybe you shouldn't because it is getting frothy. There's no doubt about it. Nevertheless, the direction is in place. We are moving in an uptrend. Now, when that trend begins to change, when it begins to slow down, when institutional investors stop buying and begin to sell, our light turns yellow. Our light turns yellow, and that tells us, okay, it's time to start taking profits. It's time to start being very careful and cautious. And when it turns red, that means we're getting out of the markets. And so right now the light is green. And so we are holding our positions. We're adding carefully to some positions. And whenever that light turns yellow, that'll change over on our triggertradereport.com. By the way, the price on that went up pretty dramatically. We had it on sale, I think, for $99 a year on the Trigger Trade. And by the way, what is that? It's our daily trading service where I put up stocks that I trade. I love to sit in front of my computer during the day, and some of you will call in, and sometimes you'll catch me here, and sometimes you won't. But what I like to do is I like to sit down, read, research, write, and then trade. And, of course, manage, many of the different businesses that we have. But for the most part, I spend my time reading, writing, researching, and, of course, trading. And so I like to share my trading ideas over on triggertradereport.com. And so you can always check that out. But we're going to put that green, yellow, red light, that particular tool, into our FTM Insider area. I think it's going to be good. I don't know why I haven't done that already, but we'll make that happen this week. Okay, we have all of these stock markets hitting all of these new highs. And it seems as if the global embrace of quantitative easing is finally beginning to work its magic. Do you remember Back in 2010, those of you who've been listening to this program for a while, you heard me talk about the wealth effect. This is exactly what the Fed was trying to create. In fact, I'm going to quote you something that was written in the Washington Post back in the fall of 2010 by Mr. Ben Bernanke. And he said, quote, higher stock prices will boost consumer wealth and help increase confidence. Let me repeat that. Higher stock prices will boost consumer wealth and help increase confidence, which can also spur spending. He continues, increased spending will lead to higher incomes and profits that, in a virtuous circle, will further support economic expansion. So in essence, what the Fed was trying to do with all of this quantitative easing 1, 2, and 3, and 4, unlimited QE, low interest rates, was they were trying to goose the stock markets to a place that we're seeing now. Because what they believe is that when you see your stocks going up in value, when the wealthy have stocks and they're going up in value, when the middle class have stocks and they're going up in value, it increases consumer confidence. And remember, this entire paper economy that we're in is totally based on faith and confidence. They talk about consumer confidence. Confidence in what? Well, confidence that the whole thing is not going to fall apart. And so the confidence has been increased because the stock prices have been raised as a result of the Fed policy, keeping rates low and then goosing it with asset purchases. So once people have increased consumer confidence, that is supposed to turn into increased spending. And the more people spend, then, of course, that leads to higher incomes, and that leads to, higher profits, and that ultimately leads to economic expansion. But what's not happening right now, and this is what's really bothering the Fed, is that companies are sitting on massive earnings, strong sales, but they're sitting on a lot of cash. Non-financial U.S. companies are sitting on around $1.7 trillion in liquid assets, and they're sitting on it. I don't know if you heard Nell Minow last week on our program. Great interview where she talked about corporate governance, good and bad, talked about Apple and Herbalife. If you didn't hear that, go back and listen to that. It's really good. But Nell said that Apple is simply a warehouse with dollar bills. And that's really what many companies have become, is they're just these warehouses with dollar bills. They're sitting on cash. And those dollar bills don't do any good if they're just sitting there. They need to be deployed either through dividends or through, investments of some sort. And so companies are sitting on cash and they're not investing, and they're also not hiring the way they did. I mean, as a business owner, I can tell you that, whenever you employ someone and then all of a sudden you have to cut back, you oftentimes find that you can get by with fewer employees and therefore boost your bottom line, make your shareholders happier, and you just learn to streamline. And this economic crisis of 2007, 2008, 2009 that is finally working its way through the system now has changed the corporate psyche to the place where they realize we don't need all these employees, right? We can get by with fewer. We can outsource to other countries or whatever the case might be. So they're not hiring. So the unemployment rate, I believe this week was reported, the official rate, 7.7%, still far too high, still far above what the Fed is targeting. And so we're keeping our eyes on that. The housing sector also is not in the place that the Fed wants it to be. I mean, home prices have been rising overall since the beginning of 2012, but 1 out of 5 mortgages are still underwater, and foreclosure rates are still very high. So the housing sector has not benefited the way that I'm sure that the Fed wants it to benefit. So that we're watching the housing sector very closely. But here's what's interesting about the central banks. The European Central Bank this week opted to leave its aggressive monetary policy unchanged. Its base lending rate is 0.75%, less than 1%. They left it unchanged. The Bank of England chose to leave its interest rates, which are currently around, I guess, 0.5%. They left those unchanged. And it looks like they are becoming more open to the idea of a new round of asset purchases. at the central bank level. And then also the Bank of Japan, which is very interesting, chose to leave its 0% interest rates unchanged, 0% interest rates. And the Bank of Japan is going to get even more aggressive, if you ask me, because they have a brand new governor coming in, and his first meeting, official policy meeting, should be the April 3rd and 4th meeting, and we're going to be watching that very closely. Those of you who have invested in Japanese stocks and have watched that, as we've talked about it even here on our program and also in our insider area in our newsletter, have benefited from the very aggressive monetary policy that's going on over in Japan as they try to pull themselves out of a funk, and it's leading to higher stock prices. And the Fed, of course, speaking, we talked about Europe, we talked about England, we talked about Japan. The U.S., the Fed, they're leaving rates unchanged. They're continuing to suppress interest rates. They've kind of stated their goals of what they're looking for, so they're going to continue their aggressive monetary policy. And when you think about hyperinflation, you think, how long can this go? How long can these countries and these central banks goose their economies before it comes back to bite them? Hyperinflation is obviously not here yet, but the signs that historically precede hyperinflation are abundant. They are all around us. So we know that hyperinflation is coming because it is a simple fact. It is an economic law. Now, some would say, oh, Jerry, things are getting better, and take a look at the markets and take a look, no, things are getting so much better, Jerry. Now you're starting to become irrelevant. Well, I even had an email this week from somebody who said, what are you talking about? Everything's better. Nothing has fundamentally changed in the economy, right? You have to understand what's occurring. When the stock market rises, you realize that can be manipulated. And that's exactly what the Fed is hoping to do. They told you this back in 2010. We told you that that was their goal, and they have finally been able to make the stock market rise to the level that it trumped where it was before the crisis. That does something to consumer confidence, and that leads to people buying more stuff. And the more stuff they buy, it leads to a better economy, so to speak. So that's what we're watching. But this thing does not end well. Let me tell you why. Because these central banks are getting the economy going through this unbelievable Herculean type of monetary policy, unprecedented. We've never seen anything like this. And whenever this occurs, there's always a consequence. Now, when the Federal Reserve takes a look at what's happening today, and they decide finally to turn off the spigot of money, I promise you they're going to be about 18 months too late. They're going to be too late to prevent hyperinflation from occurring. Now, if you'll notice around the world right now, there is a currency war. It's muted. People are acting like it's not there. Policymakers are saying, oh, no, there's no currency war. But if you take a look at a chart of the euro and you take a look at a chart of the Japanese yen, you'll see that they are in a race to debase. And the U.S. dollar has benefited from that by rising. Okay, so when the yen or when the euro go down, remember, all currencies go down in relation to something else. They're not independent of themselves, like a stock. A stock goes up and down. It's not relative to anything else. But a currency, when it goes down, it has to go down against something else, and something else has to go up in its place. And the dollar has benefited from the euro and the Japanese yen going down. So the dollar's up. Now, when the dollar goes up, what goes down? Well, things that are priced in dollars, right? So gold has been hit pretty hard as of late because as the dollar goes up in response to these other currencies going down, then gold goes down. So we've often told you to take a look at the euro or take a look at the yen and focus on them. When they go down, gold goes down in U.S. dollars. When they go up, gold goes up in U.S. dollars. So that's kind of how all this works. You don't want to get too heavy into it because it can get really cumbersome. But there's some real basic concepts that you can kind of follow. So, why is gold down right now? Well, is it down because people don't believe in gold? Is it down because the fundamentals have changed? Is it down because, it's not worth owning anymore? Heavens no. The fundamentals for precious metals, the fundamentals for agriculture, the fundamentals for commodities, the fundamentals for energy have never been better in recent memory. But we are going through a period right now where the dollar is strong as a result of this currency war that's going on. Now, the U.S. also needs to debase its currency, and it will. It consistently does. Why would a nation debase its currency? Because when your currency is lower, it makes your international trade more profitable because more people want it, right? So more people are going to come to your country because your stuff is cheaper. Therefore, you get more sales, you get more exports, and exports are part of the bottom line of a nation's GDP, so they always want to increase them. And one way to goose your GDP is to debase your currency. Okay, so that's a lot of economics 101 stuff there. I don't want to go too far into it, but anyway, you get the point. The dollar is up, gold is down, the Japanese yen is down. Now, what happens when the Japanese yen goes down? The stock market goes up in Japan. So right now, the Japanese stock market's raging, while the yen is having, it's down. So I saw this. I thought this was kind of interesting. I was looking through some different things that I had here in my office and a few of the emails that I've been getting. Rick Edelman, he is a Virginia-based financial planner. He had stated recently that one of his clients called and asked him to send him about $60,000 because he had decided to buy a Porsche. And Rick said that was crazy because just a few months ago, this gentleman, this client, was reluctant even to buy a Corvette for $10,000. But when he saw the portfolio gains occurring and accumulating in his account, his brokerage account, he said, I need to go use some of this money. I need to go celebrate. And so he wanted $60,000 to go buy a brand new Porsche. That is the wealth effect. That is it right there. If you take a look, here's a few other things that I saw when I was looking around. Every single February, there's a big Miami boat show. Chris-Craft is one of the top boat manufacturers, one of the big premium ones. Their boats cost anywhere from $50,000 to $600 or $600,000. I've been on one of those, and they're beautiful. Average price for one of these boats is about $200,000. And according to the CEO of Chris-Craft and several others, the Miami Boat Show in February, just last month, was setting records. People were going in there and throwing money around buying brand new boats. Wine companies are saying that they're selling higher-end brands. Whenever you walk into a restaurant and times are tough, you don't spring for the Dom Perignon, so to speak. You don't spring for the expensive champagne, expensive wine. You tend to dumb it down a little bit and, spend a little less. But now all of a sudden, these more expensive wines are beginning to sell in the restaurants. Here's my point. The wealth effect is taking place. It's occurring. The Fed has won. They have won exactly what they wanted to do. The problem is that when they win, you lose. You think you win because you feel like you win. You feel really good. Your confidence is up. But in reality, what's happening is they are destroying the purchasing power of the dollar through their crazy policies. So we're keeping an eye on all of this. And one more thing I wanted to throw in before I bring Tom Cloud on, because I want to interview him about some things with gold and silver. Really bring this and ask you a question. Do you know what the world's most expensive city is, real estate-wise? If you were to find the most expensive city on the planet, and you were to go and you were to say, I'm going to buy a piece of real estate there, what city would it be? Drum roll, Monaco. The world's most expensive city in the world, according to Knight Frank's latest wealth report. Listen to this. The average price of real estate in Monaco, that's where all the wealthy go. Listen to this. Between $5,350 and $5,920 per square foot. $5,350 to $5,920 per square foot in the fourth quarter of 2012 was the average price for real estate. Can you imagine paying $5,900 per square foot for real estate? I mean, that's outrageous. Now, one of the reasons why the wealthy are attracted to this area is because they have, it's pretty much a tax haven out there. While all these other countries are jacking up their prices on taxes, this has become a tax haven for many wealthy. Now, when we take a look at other areas, the second most expensive real estate in the world is found in Hong Kong. averaging around $4,500 a square foot all the way up to $5,000 a square foot. And then the other, rounding out the top five, are London, Geneva, and Paris, which I thought was kind of interesting because none of the U.S. cities were on there. New York wasn't there, which I thought was somewhat interesting. Now, one more piece of information interesting about this. 2 cities with the fastest growth in prices. If you were to find the 2 cities on the face of the planet right now that have the fastest growing real estate as far as price goes, where would they be? They would both be in the country of Indonesia, of all places, Jakarta and Bali. These 2 areas are experiencing massive spikes in their real estate. Right now, Jakarta surging by 38% per year, and Bali experiencing a 21% increase per year in their real estate prices. And remember, Indonesia is one of the areas that we have liked as an investment. In fact, the ETF that I told our FTM insiders about some time ago was IDX. That's the Indonesia ETF. It's up 9.1% in February, last month. Last month it was up 9%. So there's a surge in interest in Indonesia. It's been going on for some time. We've been enjoying the gains in the ETF. IDX is what we've been in. It's up now pretty strong, so probably not a good time to jump in. But we certainly, if you're in, it's probably a good time to hold and tighten your stop. But yeah, Indonesia is quite a growth story. A huge growing middle class and a huge bubble occurring, it looks like, in real estate. Remember, this is what's happening all over the world right now, to a lesser extent in some areas. China, growing middle class. Russia, a growing middle class. Brazil, a growing middle class. Turkey, a growing middle class. Mongolia, a growing middle class. Singapore, many of these different areas are just growing and growing and growing. So anyway, we share all that with you, and hopefully you can make some sense and maybe bring you down to earth a little bit about what's happening with the stock market. Be very careful. This is a trap. It's called the wealth effect, and they want you to go out and consume, and they want you to go out and buy. Best strategy right now is to continue riding your holdings higher, tighten your stops, get ready for a turnaround. We don't know when it's going to happen. We cannot predict when it's going to happen. We're not going to try to predict when it's going to happen because that's how you lose money. We wait for it to begin showing signs that it's happening. We wait for facts and evidence to show us that it's happening. And the light turns yellow on the FTM Insider area, and then we know it's time to start locking in our gains. So be very, very cautious, be very, very careful, and be very, very cognizant of the fact that the Federal Reserve is out to manipulate the market the way they always have, and this wealth effect is going to last for some time, but it will not end well. All right, let's head over now to our good friend Tom Cloud with this week's Precious Metals Market Update.
Follow the Money Weekly presents your Precious Metals Market Update. Here's Tom Cloud.
Well, Jerry, we got a lot to talk about. I mean, there's nothing out there that's sending the market straight up. It has stabilized and climbed back up 1580. So I think we just got to look at some of the things out there that are going on.
Yeah, let's talk about gold because I know, it's been in the news quite a bit that gold has been having a hard time lately. And I know it has some investors concerned because they see all of this crisis that's going on around the globe. But at the same time, they see all of the markets across the globe. The financial markets are going up. Stocks are going up. Even the dollar is going up. And gold just doesn't seem to be enjoying the same kind of ride. Let's kind of break that apart. Explain to our audience what's happening right now.
Well, there's several things happening. You've got a dollar climbing. It's up to 82.50. Some people think it's headed to 84 on the index. Now, remember, when this bull market started in metals back in 2000, that index is at 122. The dollar was 20% more valuable than the basket of currencies that they use to compare it to, and now it's 18% less. But yet it is climbing, could climb further. So, we've had the problem with gold because the dollar's been going up. It's certainly been one of the problems. You've got a lot of negative writing out there by the press. Of course, the press has always done exactly what's wrong, and they've been writing negative about gold for 10 years. And certainly it's like hollering wolf. At some point, you will have a downturn. But even with all that, gold is down $76 for the year. So you're talking about 4.5% since January the 1st. And while that's not good, we know that with the debt ceiling coming up on the 27th of March, the government will have to close down or raise the debt ceiling. We're seeing Boehner, Speaker of the House, on TV every weekend doing 3 or 4 talk shows and already giving the Republicans position. And so anyway, we're seeing the spokesman for Obama's team doing the same thing. So, we know they're going to raise the debt ceiling. They want to try to do it in a more orderly fashion than they did in 2011, but that's positive for gold, too, very positive. But the one thing we can tell our audience is, while the number of people buying gold right now is down from our average, the order amounts are up. We see the larger clients looking at it as an opportunity. Smaller guy, which he's just a little more cautious. He doesn't have as much to work with, and we don't see those people back in the market yet, except the ones that are cost averaging into silver, which is a smart thing to do.
Strictly from a technical perspective, Tom, because that's pretty much how I look at things, but I know the fundamentals for gold are good. They haven't changed. Nothing's changed about the fundamentals, but the technicals, when I'm looking at the technicals here, it looks like there is a very firm downtrend that we've been in since about the beginning of October of 2012. It looks like that as long as we stay above that 1550 area roughly, we're going to be okay. And unfortunately, gold has been dancing above that 1550 area. And also on the upper band of that, on the technical side, if gold can somehow manage to break out above 1610, that we would break that long-term downtrend. What do you think? Are those numbers something that you're watching too? What are the numbers you're watching?
Yeah, our numbers are very similar. I mean, it's always what you use, but I think it needs to break 1620, $10 higher than you do to reaffirm the bull market, and I think it needs to stay above 1540. So I'm $10 higher on one end and $10 lower on the other end. It's the same thing. We're thinking very close to the same thing, and I think this is a very crucial month because the powers that be would love to see gold break down every day in March that gold stays above 1556 or 1550, as you said. That is good for us, and it's good for the technicals. There's always that fear because there is so much talk about the stock markets and what's going on with the dollar. There's always that fear that it could break down, and certainly that's possible. I would never say that's impossible. But I'm watching it just like you are very closely, and we've just been in this narrow trading range since it broke down in October. But this year, we've been in a very narrow trading range. Once it broke from 1665, where it started the year, down into the 1560s, we've been between that 1560 and 1610, 7 out of the 8 weeks this year. So that is not bad for us if we stay there because, like you said, the fundamentals really, really favor gold over the next several years. We just got to get back above 1610 or 1620 to get moving.
Okay, so you got the U.S. markets at all-time highs. The Dow is at all-time highs. S&P's at good highs. Nasdaq's at 12-year highs. We have the Japanese markets at 4.5-year highs. I mean, we look across the globe and you see a lot of action. It looks like that QE is finally beginning to work. All that money printing is really beginning to show up. But silver, which typically does well in times like this, it's also having kind of a hard time. What's the story on silver?
Well, silver, there's a great story on the Huntington Post that everybody should go and read. I mean, the proof now, Eric Holder, the Attorney General of the United States, has admitted that the major banks are manipulating the silver market to prosecute them. I'm telling you word for word what he's saying, but if you go to HuffingtonPost.com and you look at the Eric Holder banks too big to prosecute, I mean, he's basically telling you, and the CFTC that governs that still has not dropped the case after 4 years, even though J.P. Morgan and Goldman Sachs and others have tried to get it thrown out. Still not thrown out. I'm still optimistic that we, the people, can win this thing. And when they do, Jerry, anybody can say anything they want. We can all make foolish remarks from time to time, but silver will go over $100 an ounce if and when that happens. It will just be gone because at that point, so we're not giving up, but we're starting to get more and more exposure about this silver manipulation. But right now, as I told you earlier, we must have 68. I mean, we sold silver to our clients. They paid for it. We're waiting for delivery of it, but we're having to wait on new silver to be processed. There's not any secondary silver hardly out there in the wholesale market. There's a shortage of physical silver, and we've seen the premium on junk silver is now $1 higher than brand new silver rounds when normally they're a little bit lower. There's some entity buying up millions of dollars of junk silver for whatever reason. So while these markets aren't doing anything, the supply is dwindling further and further. So you've got to watch that. And of course, with North Korea talking about they can hit the United States, I mean, still what's going on in Iran and Israel, and there's still a lot of powder kegs out there that, we don't talk about every day. But I think silver will get released from where it's tied down, and I still look for some very big silver numbers. And I think this Huffington article really helps our cause. It just keeps bringing different groups of people and exposing them to what the big banks are doing. But Holder just basically said they're too big to prosecute.
Okay, so let's take that scenario and just play it out. If silver is able to break free from all the manipulation, and that's a really big if, and that happens, and we see silver move up, above that $100 prices you're talking about, is that a knee-jerk reaction and then it comes back down and finds equilibrium price? Or do you think the equilibrium price for silver, or the really going free market price for silver, should be in the 3 digits? Is that where it should be right now?
Well, it should be, Jay, but there's just one thing I've learned in 35 years of doing this, and I could name you 15 people that would do what I'm getting ready to tell you. If silver right now was to move from $29 to, say, 36 or 37, they would sell. And what you have, whether it's a technical timer or whether it's someone out there that bought at a higher price than it is now and says, if it gets back even, I'm getting out. But they'll always bring more silver, so it's not the equilibrium of where it should be at over 100. It doesn't get there. It goes to 36, 37. It goes back to 33, 34. Then it goes to 42, 41. Then it goes back to 36, 37. I mean, it reacts the way technical markets react. So I do think it would rocket up, but it would give back, it would retrace some just because people would cash out for the profit, and you'd have temporary, enough material on the market that you'd have the price come down some. So it is a step-stool effect. You've got to always remember that.
Okay, let's talk about the U.S. dollar. The U.S. dollar has been also very interesting if you look at it on a chart. It's really been gaining some steam, kind of a yo-yo, but overall since about April, May of 2011, we've really been kind of in a upward trend that's really confirmed. Even though it's staggered over the last part of 2012, it's really begun to move much higher over the last several days and weeks. What do you make of the strength of the dollar amid the fact that interest rates are so low, the QE is still pumping, the stock markets are rising, and we're seeing the dollar also going up at the same time? What do you make of that? What does all this mean?
Well, I think the biggest alert that I've seen is John Williams' interview over the weekend. Last weekend, a lot of what John said I knew and many other listeners know, but he made two startling remarks that pretty much, first of all, he said that a person out there today getting Social Security checks, if you look at it from the 300% increase in the money supply since Obama has been president, that the purchasing power caused by inflation and monetary inflation, the monetary inflation, even though we haven't got all the price inflation through the system yet, like you stated earlier, is that a recipient since Obama has been in office is only getting 56% of what they were getting 5 years ago in purchasing power. That is very startling, Jerry, to hear that. The second thing that John Williams of Shadowstat said that is not as startling, but it is, and that is that his hyperinflation prediction for 2016 that he stayed with and stayed with and stayed with and stayed with he comes out this weekend and says, no, it's going to be the last of 2014 because of what you stated earlier. The QE around the world is starting now to have effect, and as it gains more momentum, it's going to start causing the inflation and interest rates to go up, and then we're going to get into moderate to higher inflation. But he's moved the time frame up 2 years just because the events of this QE thing, plus the $85 billion a month is being created, plus all the debt that we're having to buy, the Fed's having to monetize, because we still can't sell the debt on the market out there. So we've got that to look at, and of course John Williams has an impeccable reputation as an economist. So that's just something we got to keep our eye on when people like that come out and make these kind of predictions.
Now, you've been particularly bullish on platinum and, to a lesser extent, palladium. Why don't you share with our audience your thoughts on those two? And do you think that those two metals will outperform gold and silver in 2013?
Well, I told you the other day when you and I broached this subject, you've got Mitsubishi, the second largest corporation in the world. When you look at everything they do, they're heavy into the platinum and palladium sales, which I get, their newsletter every day that comes out to brokers. I mean, last year, platinum was number 1, palladium was number 2, silver was number 3, and gold was number 4 in performance. This year, they think it's going to be the same thing, platinum, palladium, silver, and gold. Now, whether I agree with that or not, it's not the point, but they make a good point, because when the strikes were settled in South Africa, rather than giving people overtime, they just cut the hours and their mining so the stuff's not coming out of the ground as fast. And this is a very big effect on platinum going forward. Our platinum sales have just skyrocketed, especially from the larger investor, when you're reading things like that out there. And I still can't disagree with them, Jerry, that platinum will probably be the largest percentage performer this calendar year. And certainly if John Williams is right, next year silver will have its final day in the sun. That's the reason we've got to keep cost averaging buying silver while it's down.
Now, Tom, what are investors buying when they buy platinum? I know many people think of silver eagles and gold eagles and that, but when they buy platinum, what form do they buy?
Well, there's the COMEX bars that look just like a 1-ounce silver bar. You got the palladium. We have Maple Leafs and palladium bars that are COMEX brands. The Maple Leafs are only $5 an ounce more. So most of our investors buying the palladium Maple Leafs and paying the $5 more. Now, in platinum, the platinum Maple Leafs are $20 more an ounce than the platinum bars, but you're talking about a metal, that's 2.25 times more valuable than palladium. So it's really not that big a deal, but it seems like the way it's worked out, we're selling a lot of palladium Maple Leafs and a lot of platinum COMEX bars.
That's interesting. Yeah, after that big, massive collapse back at the end of 2008 when platinum was down to around $800, what a time to buy. Wow.
Yeah, from 2,000 down to 800, and we have had people buying steadily ever since. And certainly with what's going on with QE, I mean, it's a very low-risk thing to be moving into platinum right now because of the stock markets and what's going on. That's just creating more demand for these industrial metals. The higher the stock markets go, so, you don't have to have, you can make money in metals when the stock market's going up, but it's platinum and palladium could possibly do better than gold and silver.
Because of their industrial demand, and as the world grows and the global growth and GDP growth, they need more metal. So
Exactly. Yeah. So it is. In fact, my 4 or 5 largest clients, he just sent gold in and put the 10% of his portfolio into platinum. So we're seeing things like that happening where some are selling something to get a little more position because they do believe, like John Williams, we're headed for much higher inflation because of all the quantitative easing going on, and we're just starting to see the signs of it, as you said earlier.
Okay, one final question, personal question, actually. I wanted to ask you, well, how are you responding right now to all of the political crisis, the economic crisis that's continuing, even though the markets are going up? It's been nice. I've certainly been in the markets. I've been enjoying the ride up, obviously with some caution. Well, how are you positioning yourself right now?
Well, Jerry, it's hard because you know that the stock market is going to have a big drop at some point, but it could go another 20, 30% higher before it does. And I think that's the hard part. And, really, when you get to a certain age, you're just more cautious. If I was a lot younger, 20, 25 years younger, I'd be a little more aggressive in the stock market because I do think it does have room to go up. But it is going to have a downturn at some point, and it's going to be, pretty big in my opinion. So I'm kind of staying on the sidelines. I've got some good preferred stock. It's still got some agricultural stocks, and I've actually bought a little REIT, a little real estate investment trust, put a little bit in that this year. So I'm dabbling around, but I'm still keeping metals as my core position of all my investments.
Got it. All right. If our folks want to talk to you, they can call you. Why don't you give out your information?
Yeah, they can call me at 800-247-2812. That's 800-247-2812. And if they're not getting our email blast that we send out a couple of days a week with economic information, buy and sell signals, it's a very confidential list. We don't share it with anybody. They can go to ftmdaily.com and hit the precious metals button and sign up for our email blast that goes out. But other than that, Jerry, we're looking forward to see how this resolves out at the end of the month with the debt ceiling.
There's a lot of places you can buy gold and silver on the web, and of course you see a lot of commercials out there. All of our listeners, I would highly encourage you to include Tom Cloud in your shopping whenever you're looking for a place to buy gold and silver. You won't find anyone who rolls out the red carpet, treats you with great personal service, and he is my personal go-to person for gold and silver. So I encourage you to give him a call if you're in the market for gold and silver. You also buy, is that true, Tom, or do you mainly just buy?
Yeah, we buy. We don't charge anything. If people got something, we'd be happy to give a price on it. Absolutely.
Fantastic. All right. Well, thanks so much for being here. We'll look forward to seeing you next week.
Always a pleasure, Jerry. Thanks.
Gold, silver, palladium. If you have questions about or are looking to purchase precious metals, there is one name to know and one name to call. Tom Cloud at 1-800-247-2812. You hear Tom every week on Follow the Money Weekly, and gold and silver are an excellent hedge against inflation. Tom Cloud has over 30 years' experience as a precious metals advisor. Don't buy your precious metals through a call center and pay inflated prices. Call Tom Cloud, 1-800-247-2812. And for a limited time, tell Tom you heard it from Jerry Robinson on Follow the Money Weekly and receive free shipping and insurance on your order. That's right. Mention Follow the Money Weekly, and your shipping and insurance charges are waived on your precious metals purchase. If you have a question about something you heard on the show, call Tom. And to secure your precious metals investment, call Tom. Your gold guy, Tom Cloud. 1-800-247-2812. That's 1-800-247-2812. You heard it on Follow the Money Weekly.
Jay Peroni, Certified Financial Planner, here with the idea of the week. This week we'll take a look at an exclusive stock paying 4.4% that's raised its dividends for 23 consecutive years. Since 2009, the all-weather portfolio strategy is up over 130%. Yes, that's right, it's more than doubled your money. This strategy combines stocks, bonds, precious metals, currencies, and real estate investments. Last June, while looking at REITs, or real estate investment trusts, I found an example of a perfect stock for both growth and income. As an investor, I love real estate because it provides diversification and can provide attractive income for a portfolio. A real estate investment trust, or REIT, is a real estate investment company that's responsible for managing a portfolio of income properties. It then distributes the majority of its profits as dividends. Through the purchase of a REIT, you can gain entrance into owning prime residential and commercial real estate without the traditional headaches that come along with real estate management. In the REIT structure, the real estate investment company agrees to pay out 90% or more of its taxable profits in dividends in exchange for avoiding corporate income taxes. This potentially allows investors to have a strong dividend income stream. Like other dividend stocks, REITs offer the potential for cash flow via dividends and also capital appreciation through an increase in the share value. The dividend income from REITs tend to be very stable, as many of these invest in large, commercial properties involving long-term tenant leases. One REIT that caught my attention is National Retail Properties, ticker symbol NNN. This is up over 22% since I bought it last June. It invests in single-tenant retail properties, generally subject to long-term net leases. It currently pays a 4.4% dividend, and chances are this will continue to rise. This is an exclusive stock. Out of 10,000 publicly traded companies, National Retail is one of only 104 stocks that have increased annual dividends for 23 or more consecutive years. The average annual total return to shareholders has been 13.3% over the past 20 years. National Retail owns a diversified portfolio of 1,622 freestanding retail properties in 47 different states with a total gross leasable area of approximately 19.2 million square feet. These properties are leased to more than 300 tenants in 36 different industry classifications. National Retail Properties is a fully integrated real estate investment trust. The company's assets include real estate assets, mortgages, notes receivable, and commercial mortgage residual interest. For investors looking for a steady flow of income along with good growth potential, National Retail Properties, ticker symbol NNN, is worth a closer look. This is a good buy up to $40 a share, and this one could hit as high as $45 a share over the next 12 to 18 months. Again, that's National Retail Properties, ticker symbol NNN. This is Jay Peroni, Certified Financial Planner, signing off for the Idea of the Week. We'll see you again next week.
All right. Well, Jay Peroni is a CFP, Certified Financial Planner, a member of our Christian Financial Advisor Network, and he also manages our very own PACE investment portfolio. If you would like to have a free 30-minute review of your investments with Jay, you can call him at 888-664-6963. That's 888-664-6963. And when you do, be sure to tell him you heard about him on Follow the Money Weekly Radio.
Are you tired of getting whiplash from the stock market? Is the return of your money more important than getting a return on your money? In these difficult economic times, it's only natural to seek out wise investing counsel. Thanks to a new service called the All-Weather Portfolio Strategy, you'll get real-time access to our service, which only invests in high-quality companies with historically low volatility. Have you ever been caught in the rain without an umbrella or left the house without sunscreen on a hot and humid day? Sometimes the weather catches us by surprise. Just like the weather, the investment markets can also catch us by surprise, and sometimes without warning. There are times when the markets soar and we miss out on gains, or maybe we have too much in the market and suffer a major decline during volatile times. That's why we created the All-Weather Portfolio Strategy. The All-Weather Portfolio is suitable for cautious investors, those with a time horizon of 5 to 7 years, those who are close to or in retirement. The goal of the All-Weather Portfolio is to protect against losses in a down market while still taking advantage of the markets when they rise. With the All-Weather Portfolio service, you'll get 24 hours, 7-day-a-week real-time access to the portfolio. You receive instant buy and sell alerts directly in your email inbox. You'll also get a special 27-page report entitled An Introduction to High-Quality, Low-Volatility Investing, a $47 value. To learn more about the All-Weather Portfolio, go to wallstreetrenegade.com/all-weather. Again, that's wallstreetrenegade.com/all-weather.
All right, where's my money? Money. Daily bread.
Follow the Money Weekly presents the Retirement Minute.
Today I would like to talk about the difference between qualified money and non-qualified money. I went to see a lady the other day and she told me that she owned an IRA CD at her bank and that she could not transfer this money to a mutual fund because it would become taxable to her when she transferred it. Most people believe that an IRA is an investment product, but it is not. It is an IRS tax code. Let me explain. There are two types of money in the eyes of the IRS. There is qualified money and there is non-qualified money. Qualified money is before tax money. That means you did not pay taxes on this money when you invested it. This money, while invested, will grow tax deferred, and you will not get a 1099 each year from the investment telling you that you need to pay taxes on the earnings. But the problem with qualified money is that you will pay taxes on all of the investment that you take receipt of in any given year. Also with qualified money, if you take the money out before the age of 59 and a half, you will pay a 10% penalty to the IRS for early distribution, and once you get to the age of 70 and a half, the IRS requires you to start withdrawing your money from qualified accounts called the required minimum distribution. Non-qualified money is after-tax money. When you invest this money, you do not get to write off this investment on your taxes, so you do not get an upfront tax break. However, while this money is growing, the earnings could be taxable each year, or it may not. It depends on the type of investment you use. For example, if you used a CD at the bank, every year that you earn interest, you get a 1099 from the bank for the amount of that interest, and you take the 1099 to your tax preparer, and those earnings you will pay tax on in the year you earned it. You pay this tax on earnings whether you took the money out or not. An annuity is a different investment. They can be classified as non-qualified money. But an annuity will grow tax deferred. In other words, each year you earn, you will not get a 1099 from the annuity company, so you do not have to pay tax on the earnings each year. However, when you start to take withdrawals from the annuity, you will pay taxes, but only on the gain in the contract. Tax deferral is a great way to grow your money faster, and it gives you the control to pay the taxes on the investment when you want to. Qualified money and non-qualified money is an IRS tax code law, and you can invest it in any investment that you want. You could use CDs at the bank, annuities through an insurance company, mutual funds through an investment company. In other words, all investment products can be either qualified money or non-qualified money. So as you approach retirement time, it is important for you to understand how each type of money is taxed so that you do not get caught paying a large tax bill that you did not anticipate. So make sure you have your financial affairs in order. And a good way to start this process would be to contact me through the Christian Financial Advisors Network by email at John, that's JOHN, at CFAnetwork.org. Or you can call me toll free at 888-914-9909. I would be more than happy to review your financial situation with you to make sure your financial house is in order. And thank you for joining me this week for your Retirement Minute.
All right, friends. Well, that brings us to the end of our program. Thank you so much for choosing to allow me into your life each and every week. It is an honor and a privilege to be a part of yours as well. And as always, I leave you with this final word, this time spoken by Mahatma Gandhi, when he said, "The 7 deadly sins are wealth without work, pleasure without conscience, science without humanity, knowledge without character, politics without principle, commerce without morality, and worship without sacrifice." Just something to think about. Remember, friends, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and I'll see you right back here next weekend. God bless.
The views and opinions expressed by the guests on Follow the Money Weekly do not necessarily represent the views of FTNDaily.com or Makers Group Financial, LLC. Even though these are proven strategies, Jerry Robinson is not a financial advisor, and his guests are not legal or tax advisors. You should always consult a trained financial advisor and or tax advisor before making any financial decisions. John Burrs is a registered representative of and does offer securities through Sycor Securities Incorporated. Lifetime Decisions Management Incorporated is not a subsidiary of nor controlled by Sycor Securities Incorporated.